This demonstration video will follow up problem 36 that you just did and add a little bit to it. So I'll do a bit of review here to make sure we understand the first part of topic 13, which is estimating for bad debts. As I said earlier in the introduction to this topic, this is a fact of life for most businesses that deal with credit. Unfortunately, not everybody pays what they owe, and we have to deal with this from an accounting point of view. So there are two steps. First of all, we have to estimate ahead of time what we think will happen. And this is a part of accounting that's fairly new to you here, because this will happen from time to time, and it's not based on hard and fast numbers, because we need to make some assumptions. So in topic 36, you had this piece of direction. It said during the month of April, the flower shop made some sales on account, and they estimate that each month about 0.5%, that's 0.5% of all sales on account will eventually become uncollectible. They will become bad debts. So if that's a fact of life, we can assume that will happen again. We're not sure when and exactly which customers, but we will assume that it will happen because it has always happened in the past. So we make an adjusting entry. That's what this direction calls for. So let's briefly review this. Let's go back to our cash receipts journal. And incidentally, I've added a little bit of information. I've added some more journals and ledgers here, and we will use those in just a few moments. So let's go to the cash receipts journal, and one of the things I've added is shown on the first line 1 here. On April 30th, there are cash sales of 423. We collected sales tax and a total debit of 447.32. We collected that much cash for cash sales on April 30th. The second entry is what you should have done in problem 36. We see a debit to uncollectible accounts expense of $64.90 and a credit to allowance for uncollectible accounts. These are the two accounts we use when we make that adjusting entry to estimate our uncollectible accounts. And we base the $64.90, as we said back in the directions, on this amount of money, the $12,980 that represents sales on account for the month. And we use 1.5%, which in decimal form is 0.005. You multiply the two, and you come up with $64.90. So we then had to, do some posting. And we first of all went to the expense account in the general ledger, and we debited by $64.90 the uncollectible accounts expense. And if this is an expense account, eventually, if this is a total, that would be shown on the income statement. All expenses are shown on the income statement. And then the $6,200 was put back into the journal. The allowance account was credited by $64.90, and that's also in the general ledger. The allowance for uncollectible accounts. You see two numbers there. I want to explain this in a moment. This is our current entries, April 30th, and we have the credit of $64.90 that came from our cash receipts journal, page 8. Back in March, we had the same kind of entry, the same adjusting entry at the end of each month. March shows a credit of $150. So we expect at some point in time, a total of $214.90 will end up being bad debts. Now we don't know when, and we'll show how this works when a debt truly becomes a bad debt and we have to write off a customer's account. We'll see that in a few moments. But you see a credit back in March, and there's nothing else in here except the estimate in April as well. Now, because it was put in March and then in April, doesn't mean that they will become bad debts in the month of March or the month of April. We will work with customers as long as we can. Companies work maybe several months with a customer, maybe longer, to collect an account. So this is not something that happens frequently. Now, let's go back to the cash receipts journal. You see the account numbers were put in there, and it has now been posted. But I want to look more at how the 6490 was calculated. The directions basically gave you the information in problem 36. So you just had to multiply it out. In reality, an accountant doesn't have directions. He or she would have to look at the information given in the books of the business. So we would go, for example, to the, after things are posted, we would look at the sales account, and we will see that after we post the journals, we will see a credit of $12,980. That came from the sales journal. There's another number here that came from the cash receipts journal. So if you go there, this is the cash credit of $423 that was posted. This was a cash sale that was posted to the sales account. Now, when you do the estimation, when we estimate for bad debts, when we estimate for uncollectible accounts, we don't use the total of the sales account. Important point here. Don't look at this number. Rather, we look at only the sales on account, and that came from the sales journal. So the 1290 is used. If we look at the sales journal, we use that number, 12,980. This is the sales that we made on account. Right now, we're not going to worry about the sales tax. We'll deal with that later. I'll explain how that's handled. We don't use the total of sales plus sales tax. We use just the sale itself, sales on account. Important point. And again, as in all videos, you can review this, back it up, and listen to it again if you need to. Now, let's look at the second part of what topic 13 will be about. After we've made the estimation, and that's what, again, this is what you did yesterday with problem 36, we estimated in the future we're going to be losing some money. We're going to be turning some of this, unfortunately, into bad debts, and that was our estimate, $64.90. Now let's look at the other part of topic 13, which deals with an actual writing off of an account. There's a customer that we've worked with for months and months and written letters and phone calls. We've tried all kinds of things, but it turns out that we just cannot expect that we're going to collect this money. So we will have to write off this account. Let's say this customer is in our accounts receivable ledger, and the customer is Kelly Green. If you look down here, these customers may look familiar from topic, actually from the test from topic 12 and then the problem 36. But Kelly Green, I added a new transaction here that was put into her account way back in October of 2019. On October 17th, 2019, Kelly Green bought something from us on account. She charged it, and she owes us $95.50. And we've determined that this is not going to be collected, and we're going to have to write off the account. So let's take a look at how that's going to happen. We go back, let's use again our cash receipts journal, and let's assume that we will use the same date here, just to be consistent, April 30th. And now we're going to write off her account, and we will use the allowance for uncollectible accounts again, and we'll see how that is used. And obviously we have to use her account, Kelly Green. So we will now need a source document. Let's say it's credit memorandum 15. There'll be some sort of source document for this. Let's just say it's a memorandum. And the amount that we're going to use here will be the amount that is in her account. $95.50 is what she owes us, and that's what we are going to be writing off. So this will be a debit to the allowance account, and it will be a credit to not only her account, but also a credit, to accounts receivable. So this is where the $95.50 is put. And when we post this, we will see what happens. So a debit goes to the allowance account. Let's go to our general ledger, find the allowance for uncollectible accounts, put the date. And this is cash receipts, page 8. And this will be debited. Now look at the total, and obviously what happens when you debit, the total will go down. So we expected that we would eventually lose $214.90. Now we actually did lose $95.50, and we still expect to lose another $119.40. So unfortunately, there may be other debits here at some point in time. So this indicates a deduction to the allowance account, indicating a bit less now that we can anticipate as a bad debt. 1135, account number, back into the journal. And now we go to her account, Kelly Green's account, in the accounts receivable ledger, and we credit. We credit because that's where we put it, and that's what we will do to the accounts receivable account, also in the general ledger. But to her account also we will credit. So we will go to her account, now today's date, cash receipts journal, page 8, and we will credit $95.50. So her balance now is showing 0. Now we don't want to indicate that she paid us because she didn't pay us. This is when we use the description column once again. So we will put something like this. Wrote off account. If I could spell it correctly, that would be nice. So if she comes back to us later and wants to charge something again, we can check her account and see that we had to write off her account, so we're not going to give her more credit. If she wants to buy something else from us, probably we will insist on cash. So that's why that is put in the description column. And 1130.3, back into our journal. So that's how that's written off. Now, eventually this $95.50 will be credited to the accounts receivable account in the general ledger, because that account shows the total amount people owe us. If we've written off $95.50, it's going to be credited because it will reduce that account. So that will be credited to the accounts receivable account in the general ledger. And again, from cash receipts, page 8, and a credit of $95.50, reducing the total that we can expect to collect. And 1130 goes back into the journal at the bottom. So this is how this is handled. And again, this is a bit complicated. So the two pieces of it, one is an estimation and one is an actual write-off of an account. So our description is just that. Having a tough time spelling today. Now, you'll have a problem that will deal with this. So I want you to go back to your course page at this point and do the next problem.